Wedgewood partner CIO David Rolfe. David, first let me get you to weigh in on the conversation that John and I were having at the start of the show in terms of these layoffs we're seeing in tech, particularly here in the Bay Area. Morgan Stanley says it's not a canary in the coal mine. How do you see it?
Maybe it's not a canary in a coal mine for the broad U.S. economy, but I think it's going to be very significant in the greater Silicon Valley industry. We had, look at how many years we had of 0% financing, free capital. It was open, free running. And the employment growth at these companies was just, it's really hard to fathom. And I think that we may be looking at, in the near future, we may be looking at aggregate unemployment figures ex Silicon Valley. So, but I think some of these companies are just getting started. And maybe, maybe Twitter might be a little bit of a microcosm in that if you can cut back a lot of folks and still, keep the trains running on time, maybe that's a little bit of an inkling for other companies. But, we own some tech stocks that have already announced significant layoffs. We're probably in the early innings of that.
That definitely remains to be seen, whether the trains can be kept running, David. But your point is well taken. Twitter and Salesforce, two companies, downtown San Francisco that we're seeing layoffs that are going to affect the broader economy. Let's get to your Taiwan Semi pick. Berkshire Hathaway also likes the company. What do you like about it, and how are you viewing that China risk?
Well, our thesis on Taiwan Semi, we call it, a couple of things. That we think it's one of probably arguably the most important company in the world. We think it's interestingly enough, it's probably one of the most significant companies, much less technology companies, that a lot of people don't own. It's an ADR. It's not in any of in the S&P 500. It's in none of the benchmarks. And in terms of what's going on with China, again, word from the company is that they believe it's manageable. There's certain changes that they can make. There's also other demands where they can shift some of that production, but we're looking at, we're in the early innings of this too. And we'll see as the year progresses. We're taking the company at its word that, it is manageable, and there's some other demands where they can shift some production.
So TSMC is well off of its lows when it dipped below 40 a few weeks ago, and it's back, around 54, 55 area. How much of what you're looking at where TSMC is concerned, and I hope I have that right, how much of what you're looking at has to do with TSMC specifically versus the importance of advanced node chip manufacturing? And so how do you play the desire now for onshoring, for friendshoring of that? How much does it matter, the share of U.S. manufacturing that TSMC gets and the amount of traction that Intel gets if that plan works out?
Well, it's all part of the mix on how we're thinking about, John, advanced technologies here. Certainly, N7, N5 are the big profit drivers. High performance computing is a big performance driver, either here in the United States or internationally. I think also what might be somewhat underappreciated is that, they're ramping up pretty darn quickly here, the next generation 3 nanometer 3N, and their big competitor is Samsung. And it looks like Samsung is going to be, their latest and greatest is probably going to be used largely in-house with their own products.